and welcome to The Retirement Architect. My name is Cynthia Defazio. I'm joined today by David Reyes, and David is founder and chief financial architect of Reyes Financial Architecture. David, how are you today?
I'm well. How are you?
I am doing fantastic. Thank you so much. Always a pleasure to see you.
You too.
I know you've been so busy, so Thank you for taking the time to do the shows. And how's the radio show going?
Thanks for asking. Great, actually. I mean, it's been, last year with people not driving as much, we didn't have as many radio show listeners. So that was kind of disappointing, to get to, I've done it for 15 years on radio. So definitely from January forward, it's been really busy, which is great. Because radio, I've only done television for the last couple of, few months, but radio I've done for years. So you have people that have listened to you for a long, long time. So it's kind of fun. David, I'm listening to you, and I'm finally ready to do something, or I have this question that's been burning. So it's nice to see, hopefully, people getting back to normal a little bit more. That's fantastic. And is that on Sunday morning as well, David? Sunday morning, yes. Okay. Yes, Sunday morning, 9 a.m. Excellent. So Sundays are busy. Sundays are very busy, most definitely. Yes. Well, obviously, so much is going on right now. We've talked about this, obviously, going through 2020, having the pandemic, obviously the new presidential election obviously took place. We have a new president, of course, in office and staff. The stock market right now, wow, obviously going crazy. What are your thoughts on the stock market right now, David? Yeah, from any metric that you look at, the market is extreme valuations. We went from panic to euphoria. Yeah. And I've mentioned this before on the show and on my radio show. I've never seen a market in my 25 years where we've gone from basically full-on depression, unemployment from 3.5% down to 15% in 90 days, basically. Stock market crashes 35%, and then guess what? 6 months later, the market's up 55%, and we're back to even. Sure. And now the market's now in a euphoric stage. And so it's concerning to me. It's kind of like, we're in a recession. It's like having a cold and taking an aspirin, and then taking your temperature and are you sick or not, right? That's what stimulus does. It's like, are we in a recession? Are we not? Is the economy good? Is it not? And so the fact is that people are, I think, we've gotten ahead of ourselves with the market. And that's what happens with markets. It's a discounter. So if things are going to be good around the corner, the market's going to price that all in today. So that's why the market is screamed. I mean, you're talking, the market was down 35% in March 23rd of last year, and it's basically up 75% since that time frame. Wow. I mean, just straight up. Small company stocks are up over 100%. And you're talking in 10 months. Yeah. So this is what happens though when you come out of everything now with technology, with the Federal Reserve, the way they deal with things is faster. Yeah. So market's going to crash faster. It's probably going to recover sooner. We don't always know that. Right. In 2008, it took 5 years to get back to even. It took 5 months. Now we can't count on that. Yeah. And I've mentioned this before. I had a handful of clients that came to me in March that had to go back to work, or had to sell real estate or other assets to retire because they lost all this money they sold low, and it really hurt their retirement. So right now, I think one of the biggest risks is the stock market itself, and people not having. It's okay when the market's going up, it's great, but do you have a plan to protect the downside? Right. We do. I do for my clients, but do you? And that's the question I place to people. Yeah, we want to participate in the market, but how do we plan to protect capital when markets turn around? And I think that's the missing piece for most clients' portfolios from the equity side. Sure. We've talked about this in the past. Obviously, euphoria is another word for greed. So people are going crazy and they just want to grab everything they can. But you've always taken a more conservative approach with your clients. We've talked about this, how you're specializing in the distribution phase of someone's life, which means obviously the accumulation years, they're so busy, they're accumulating all their nuggets, if you will. But then when you get to the distribution phase, you're preserving those for a long time. Some people are retiring now so much earlier, David, than what we did in the past, correct? Yeah, and living longer. Yeah. I mean, that's living longer is kind of a blessing and a curse. It's great. What's our health like? If we don't have our health, nothing matters. I always like to say, right? For my own self, I've got 3 kids, and I got to make sure my youngest is 6. I got to make sure I'm still ticking here, right? Yeah. And so for my clients as well. So yeah, I mean, I definitely would say that retirement is a lot more challenging. I mean, Social Security is something we haven't talked a lot about. Yeah. I'm concerned about Social Security. I remember when I started in 1995, this 2033 was when the Social Security Trust Fund was was only going to have 75% of the assets to pay distributions. Well, now I'm getting old, right? Because now that's around the corner.
I know,
and there's now concern about future distributions. In fact, a lot of the retirement software that we use we can plug in 20% reduction in Social Security benefits. It's there.
Wow.
So now Social Security, above and beyond everything else, that with longevity, they're talking about having to do some changes with that.
Yeah.
Now, it doesn't mean people are going to get less Social Security. But I will tell you, my younger clients are coming to me today that are maybe in their 50s, they're discounting Social Security. I think it's going to be there no matter what form. So when you focus on the retirement income planning side, again, that changes the equation.
Okay.
Because, let's say Social Security is a big piece of our retirement income. Well, if that is, and we're concerned about the viability of that or how much of that's going to be paid to us, we better have a plan to subsidize, to fill that gap, that income gap. And so it's definitely, with interest rates low, with inflation being an issue that I think is here upon us today, and it's going to be a problem going forward. With interest rates low, Social Security becoming a potential challenge. If you're already getting Social Security benefits, I'm sure it's not an issue, but if you're in your 50s and planning on that, I think we need to take a look at that. So, those are things out there that I wasn't talking about 10, 20 years ago,
right,
that are now here today.
Well, I think it's interesting when you think about it. A lot of people were taking advice from friends at the water cooler, and they're saying, okay, take your Social Security as soon as you can. It's not going to be there in the future.
Yeah.
But that was not really the truth. It was just more like that fear, like we've talked about. There's so much fear being caused for no reason at all. Yeah,
it's going to depend upon, again, that's why having folks on retirement income planning first.
Yeah.
Right? Focus on the income, right? Then we can backfill with other types of investments. But the fact is that we talked about annuities. Sometimes an annuity is simple as, okay, here's how much my Social Security is going to be. Here's how much I need for my fixed expenses. I'm going to buy an annuity that covers my cost. The income gap we talk about. And so that might just be a simple one. Maybe we now are going to use more of our assets to create a lifetime income benefit because we're not so sure on Social Security, right? So these are the kind of questions that I'll pose or thoughts I'll pose to a client, because especially for somebody younger, because maybe you're not going to have that kind of income.
Sure.
So maybe we need to create our own income, our own pension, our own Social Security. So it's just it's dynamic, it's changing, and I think to be effective and to be good at your job, you really need to be looking at those things and really bringing those challenges up to a client so they can make their own determinations.
Sure.
I'm just really there to fulfill a need of a client, to do a job, to protect their capital, to maximize their income, to make sure they don't run out of money. And there's just different tools to do that, and everybody's going to have different comfortability. I would just say, as long as we agree, that's okay. If we don't agree, then that's a problem. And that's rare, but if we don't, I'm responsible. So I don't want to have a problem.
Exactly.
And so, but I just think it's you have to be more creative to have better outcomes right now than you used to. So, but it's fun.
Absolutely. I know you have such a passion for what you do, and everyone has a story, like you've mentioned in the past. You love listening to that story, hearing that story, and then designing a plan that's going to work for them. This is the perfect time for us to open up the phone lines, David. Would you agree?
Yes, thank you.
To the viewers at home, the number to call is on your screen. That is 866-739-3775. If you have questions about how to retire comfortably, David has the answers for you. What he's offering you today is a complimentary consultation to the first 10 callers only. Once again, that number to call is 866-739-3775. You've worked your whole life to get to the retirement years. You deserve to have the retirement of your dreams and sleep comfortably with peace of mind at night. Again, first 10 callers only, please. That number is 866-739-3775. We'll be right back after this very short commercial break.
How confident are you in your current financial plan? Do you know with certainty how the recent market volatility will affect your future hopes and dreams? How much are you paying in taxes? And how much are you losing to unnecessary high fees? You didn't work to save this money so that you could spend your time worried in retirement. Now is the time to take charge of your finances so you can feel confident about your future. Call in during the next 30 minutes of today's show only to set up an absolutely complimentary, no obligation, full-blown financial review that will result in your own customized written plan. This is a $999 value that we're giving away complimentary to the first 10 people who respond. We'll start with a full-blown analysis of what you already have by running a report to untangle how much you are currently paying in fees, how you're allocated for risk, and what it's costing to work with your current advisor. Next, we'll identify your goals. Where do you see yourself in the next 5 years? Where do you want to go? And who do you hope to go there with? Is your current financial plan set up to get you there without mishap? Let's design a roadmap to create a financial plan you can follow with confidence. Get the piece that so many people are missing from their retirement. Find out how having a written plan can make a difference to your retirement dreams. Call now to schedule your complimentary, no-obligation, full-blown financial review today.
Welcome back to The Retirement Architect. My name is Cynthia Defazio. I'm joined today by David Reyes, and David is founder and chief financial architect of Reyes Financial Architecture. David, a great show that we're having today. Obviously, I love listening to you talking about the stock market and planning a very conservative approach for your clients. But with the phone lines going crazy, because I'm watching them light up, so I know you have way over 10 callers right now. Who is your ideal client? Who fits best?
Good question. You know, doing this for a long time, my clients used to be pre-retirees in their 50s, and again, as I've gotten older, my clients have gotten older.
Yeah.
Our probably average age of our clients about 67, 68. Age doesn't matter. I'm just giving you some reference relative to that. But people that are pre-retired, they're about to retire, or retiring, or been retired for many, many years. I would say it's a mix of the two. We work with business owners as well, so I have a lot of business owner clients.
Okay.
We do a lot of tax work and pension work and little different things. My partner's a CPA, so we'll do a lot of more sophisticated things that need to be done on the, because we'll talk a little about taxes, and so business owners still have some good tax benefits that are out there that the rest of us don't have necessarily. But yeah, typically our clients have at least $500,000 or more, and average is over $1 million. But people that have spent their life saving their money, they don't have to be the greatest investor ever, but they were probably a great saver. Typically they have a 401k, they have some other savings, they may have a rental property or two, may not. But in the great state of California and San Diego, a lot of people do have income property. And so we do give a lot of advice on real estate and real estate finance and all types of things like that, taxation. And so somebody who can have simple issues such as, David, how much income can I take out of my portfolio, to more complex estate issues and tax issues. But typically somebody at least has $500,000 or more of investable assets and that wants to have a conservative growth and income plan.
Okay. David, let me ask you, because you mentioned obviously estate planning, legacy planning. How important is that as part of someone's portfolio, if you will, for their retirement plan?
Well, I think it's really important right now, especially if you have significant assets, because under the Biden administration, they're attacking estate tax. So right now, the estate tax really doesn't kick in for an individual until they're over $11 million of assets. So it's pretty high. So if you're married, it's over $22 million.
Wow.
So the majority of 99% of the population doesn't have to worry about that. But there's talk to help to fund some of the things that they want to do is raising income taxes and also reducing the estate tax exemption maybe all the way down to $3 million. So what that does, it puts people in a position to where they may all of a sudden have to start focusing on, wow, if my estate's somewhere near that, then maybe I need to review what I have to make sure that I can mitigate the estate taxes that I would pay that otherwise wouldn't be there. So I don't think there's a question at all that the estate tax exemption is going to be reduced significantly. What that number is, I don't know. That'll be negotiated, but I would imagine it's going to be pretty aggressive.
Okay.
So just above and beyond we have our own estate plan attorney at our office, so she's great, Nicole. Awesome. And so we do free reviews for people that are watching. If they want us to review their trust, we'll do that for them as part of our review process. But the fact is that that's important regardless. A lot of laws have changed. There'll be more changes. So about every 3 to 5 years, you should have your trust reviewed regardless. If you don't have a trust of something and you have significant assets, you should look at that.
Okay.
But I think with what's going on right now with taxes and really estate taxes being in the crosshairs of the administration, I think it's something that needs to be looked at, especially if you're at that $3 million plus range, for sure.
Okay. Let's talk a little bit about the difference between a will and a trust, in case someone in the viewing audience is thinking, well, I already have a will, I should be all set. But what is the difference there, David? Yeah,
so a will, the problem with a will is you can still have a will and have things go through probate is the problem. And so, you still have taxation and issues like that, to where at least with the trust, yes, you have it's a will, a document. It says, here's what I want my stuff to go to.
Yeah.
But you also have powers of attorney for healthcare powers of attorney. You have your financial powers of attorney. And you get the estate tax exemption. So you get the $11 million exemption. Now again, the majority of people don't need that. My thoughts are pretty strongly that's going to be reduced down to $3 to $5 million, so that will be an issue. So if you did just have a will and you haven't a sizable estate at all, it's going to go through probate, and that means taxes. Typically, I think probate costs about 10% of the estate.
Wow.
If I'm accurate.
Okay.
And on top of that, if you have family members that are not going to be getting the assets that you wanted them to get, that's a problem. So we highly recommend that if somebody has, typically if they're hiring us for planning, they typically have assets enough to where they should look at having a trust if they don't have one.
Okay.
So part of our process, when we go through the review process, we do counsel clients on that, prospective clients, say, hey, look, you might want to sit down with the attorney to discuss that.
Absolutely.
So it's an important piece, especially for healthcare. If you don't have powers of attorney and you're on a life support and you're terminal, whatever that is, and you don't want your family to have to pay, for those types of costs to kill the estate, then the fact is that those only can happen in some cases with these powers of attorney that are inside of a trust, if that's not documented properly. So, those are the kind of things that we want to worry about as well. So trust we're all for, but now again, especially from an asset protection standpoint, I think you really need to be reviewed, looked at, or implemented.
Okay. You mentioned healthcare costs. Let's talk a little bit about that, David. Do you feel that they're going to go up in the future? Because I think everything else is going up in the future, right? So,
I mean, healthcare cost of average, I remember when I was first using long-term care back in the 90s, I mean, we were projecting out 6% cost, and that's panned out. It's about 6-7% compounded. So that means that it theoretically doubles about every 10, 12 years. And so absolutely, absolutely we're seeing, I've shared the story with my grandfather. I mean, he lost his entire estate due to long-term care costs. Had no debt, nothing, had his savings and his retirement gone after 5 years. And so absolutely, with what's going on with the agenda, what's happening with, again, this administration relative to, taxation and things like that. Again, these are inflationary. You talked about the stimulus is inflationary. You build a nursing home facility. Is it going to cost more money today than it cost 5 years to build? Yes. So everything is going to cost more. And I think that is another missing piece. A lot of folks just don't want to spend the money for long-term care. And we don't talk a lot about it on this show. But I understand it can be expensive. There's some more conservative ways to pay for it. But I look at it like asset protection. So if we have the money and we can spend a little bit of money to protect our nest egg, think of it like insurance for the assets.
Sure.
And that's how I approach it. And not everybody can do that, but if somebody has the actual money to, potentially to pay a little bit, it can make sense. But yes, definitely healthcare costs are going to be in the probably like education. I think education has averaged about 5-6%. While we've had inflation at 1.5 to 2, you've had healthcare costs, education in the 5-6% plus range.
Okay.
So I don't think that's going to stop. It's probably just going to accelerate.
That is a really important component when you think about it in that way, David, because obviously we've talked about people are living longer. So your healthcare costs, if they're continuing to rise every single year, that can deplete someone's portfolio quite quickly if you're not prepared for it.
Yeah, absolutely. And thank God it's enough to where, it's outliers. I mean, a lot of people are not having devastating, healthcare costs like that, but it happens. Somebody gets a cancer or a procedure they need and isn't part of their, their Medicare or whatever that is. I see it happen. Luckily, it's not that often, but it's that one time. You don't want to be that one time. So, it's really important, especially if somebody has the assets to pay for that. That's why we have insurance. We don't want to take on, that's why do we pay for health insurance? Why do we pay for homeowners insurance? We don't want to take on that liability. So I like to educate clients. After we go through our initial process of they become a client, we'll spend a whole meeting just on healthcare, on long-term care costs, because it deserves that. You can't do it in 5 minutes. So typically after somebody becomes a client, we'll set up follow-up meetings, and one of those first will typically be long-term care and healthcare.
Okay.
And how do we deal with that? What are your specific needs? Do I advocate for that? Is it something that we just want to learn about? And if I have strong feelings that they should probably look into it, then we definitely will do that. But that's typically one of those follow-up first meetings is going to be after they're a client, is going to be talking about what you're talking about, long-term care, healthcare cost, and is it reasonable to afford to pay for something to defer those costs or not have us take on those costs.
Sure, and a lot of that is based upon someone's family medical history, I'm assuming. That's how you kind of help guide them?
And just their own willingness. Some people are just at it, in a good way. If they've experienced that, it's the more we've experienced that kind of trauma, so to speak, our parents or friends went through a long-term care event like I did, they're going to be more prone to be open to that. Or, they've had a family history, or they just have the assets and they want to make sure their kids or whoever they want this to go to or go, the whole assets and not get taken out by long-term care and healthcare costs.
Sure, that makes perfect sense.
Yeah.
This is the perfect time for us to reopen up the phone lines to the viewers at home. Would you agree?
Yes, thank you.
To the viewers at home, the number on your screen to call is 866-739-3775. If you have questions about how to retire comfortably and need a plan put in place, David has the answers for you. Again, this opportunity is available to the first 10 callers only today. He is offering you a complimentary consultation. The number is 866-739-3775. We have to take a very short commercial break, but when we come back, we're going to have some more questions and answers for David about how to plan your perfect retirement. So please stay tuned.
As a good saver, you've been putting away money during your working years. Studies find that the biggest fear of retirees is running out of money. Market volatility isn't just the downward movement of stock prices, it's the size and frequency of change. The more dramatic the ups and downs, the higher the volatility. This can put savers who are newly retired or a few years away from being retired at greater risk. Today's generation of retirees is not receiving traditional pensions as our parents or grandparents did. Instead, we have retirement accounts such as 401ks or 403bs. These accounts typically expose your money to market risk. The last thing you want right before retirement is to lose a portion of the money you need for income. But how do you turn these accounts into a retirement income? Is it safe to keep all your retirement money sitting in the stock market? The last thing you want is to lose a portion of the money you need for income due to market loss. By working with a financial professional, you can learn how to turn a portion of your savings into an income stream for life and income for the life of your spouse if you're married. We all have moments in our lives when we wish we had taken action sooner. Don't let procrastination reign on your retirement parade. Act now before it's too late. Please call our office to set up your no-cost, no-obligation retirement income review today.
Just weave it in there.
And welcome back to the Retirement Architect. My name is Cynthia Defazio, and I'm joined today by David Reyes. And David is founder and chief financial architect of Reyes Financial Architecture. David, a great show that we're having. And again, the phone lines were lighting up. But let's reiterate, obviously, your ideal client is $500,000 and above in investable assets, correct?
Correct.
So
yes.
we should definitely make that clear in case someone's wondering.
Yeah, so our offering is if somebody has $500,000 or more in assets, and again, we're a boutique firm here in San Diego. I wish I could help every single person. Again, I'll talk to everybody, but I can't always take everybody on as a client. But if you have $500,000 or more, $500,000 or more, then we do our full opinion, full review. We'll do a fee analysis. We'll do an income plan for that client. We'll do a risk assessment, so complimentary, and they would pay a lot of money to get that done. So we're happy to do it.
Definitely.
But that's our only requirement.
Okay, excellent. Well, thank you so much. Also, I'm glad that you mentioned hidden fees and fees, if you will, because we have some questions regarding mutual funds and actually fees. If you don't mind, I'm going to throw a couple viewer questions at you.
Yes.
Okay, it says, here's a great question. David, I own a mutual fund. How do I know if it charges a load, and what is it?
Yeah, got it. So with mutual funds, we don't use mutual funds as a firm. Try to simplify, what part of my job for my clients is to reduce costs as much as I can, whether it's annuities, whether it's investments, mutual funds, whatever that is. So mutual funds are really kind of a dinosaur investment. It doesn't mean they're not usable. It's just that as a rule, we just don't use them. And so what a load means is a commission that somebody's paid. So typically they can be up to 5%. So if you put $100,000 into a mutual fund, some mutual funds, now this is not as prevalent. It could cost you $5,000, meaning that you have now $95,000, not $100,000. Now, most of the times that's not the case. What you'll see is fees that are in there. The typical fee, the average fee according to Barron's is about 3.14%. So if you have $100,000 in mutual funds, you're paying $3,000 a year, both in internal and external costs. It's a lot of money.
Absolutely.
And that's a bigger, if we're talking about, I was talking about earlier, the stock market's average the last 20 years, 6%. Well, if you're paying 2 or 3% in fees, you're not getting 6%. What about taxes? What about other things like that? So we want to do the best job we can to mitigate the costs.
Okay.
So what we'll do with that is we'll do a fee audit as part of the second opinion review. Again, we'll do a fee audit, we'll do a risk assessment, and we'll do a retirement income plan for them as part of our second opinion. And we actually have software that's institutional software that will actually break apart their investments and tell them exactly what they're paying and equate it to a dollar amount. I can tell you on average, just off the top of my head, if somebody has $1 million portfolio, they're probably paying anywhere between $20,000 to $25,000 in fees that they have no idea they're paying.
Are they
Yep.
often really surprised when they come in and you're able to uncover this for them?
Yeah, they don't believe it at first. I have to show them.
Sure.
I have the spreadsheet to prove it to them. I show here's what it is. So you have things like you have your basically fund fee, right? You have a fund fee that you see, and then there's internal costs like trading costs.
Yeah.
There's things called cash drag, terms I don't want to get into today, but the fact is there's multiple fees that are inside of a mutual fund, and that's why we don't like them.
Yeah.
I want to make it
Yeah.
simple. I don't want to have all these costs and expenses. So what we're going to do as a rule, we're going to use individual stocks. You've heard me talk about dividend stocks a lot, so
Sure.
I love dividend stocks. When I own stocks, I want to make income. So if you own a stock in today's environment, there's no fee to own the stock.
Okay.
There's no fee to trade stocks anymore, pretty much with most custodians. So we have no cost to trade and there's no cost to hold it. Why would I want to own mutual funds that are going to charge me 1%, 2%, 3%?
Exactly.
So part of my fiduciary duty to my clients is to mitigate those costs. So we're going to use individual stocks. We're going to use strategies and investments called exchange traded funds, which are a lot less expensive, more tax efficient, more liquid. They're the kind of the mutual fund 2.0. And so again, I'm not here to beat up mutual funds, but the fact is, and the sad fact is with 401k plans in particular, is that's all that they can invest in.
Yeah.
So the mutual funds, so everybody who's invested in their 401k plans is paying too much fees,
Wow.
whether they know it or not. So once we take them through that, then they're shocked about how much they're spending, and it's fun because then they don't like the fact they're wasting all this money and making somebody else wealthy, but they're happy that they know now that there's other alternatives to do that to reduce their cost.
Well, let's talk about how those can erode someone's portfolio, those hidden fees over time. David, what is your opinion on that?
Yeah, so we're giving the example. So if the market average of the last 20 years from 1999 to 2019 was up 6.1%, okay? So if you paid just, 2% in fees, right, you're now at 4%. Now again, that's not taxes, that's not inflation.
Yeah.
All of a sudden, I'm worried about inflation. So really, we have to worry about taxes. How do we mitigate taxes? How do we reduce fees in the portfolio? And so that can be significant. Again, I was mentioning to you on $1 million portfolio, you're probably talking an average of $20,000 a year in cost. I mean, that's outrageous. I mean,
is.
over 10 years, you're talking $200,000. Wow. I mean, it's outrageous. So that's part of our duty. How do we mitigate the cost? Again, because there's plenty of ways to get similar, better outcomes with equity investments, especially protecting downside than just using mutual funds. So it's part of our review process.
Absolutely. Well, David, only about 45 seconds left in today's show. Any final bit of advice you want to give the viewers at home?
Take advantage of our offer. I love to talk with people. I love to sit down with you and help you. It's complimentary. There's no charge. Again, you have to have $500,000 or more in investable assets. We'll do a fee audit. Look at the fees that you're paying. We'll do a cash flow plan for you. We'll also do a risk assessment for you. So we'd love to talk with anybody who's willing to meet with us. But it's fun, and we're excited to talk to people.
Well, I know you have a passion for what you do. Your whole firm in general, everyone loves what they do. To the viewers at home, thank you for watching. Be safe, be happy, be blessed, and we will see you back here again next week. Keep the questions coming.